My guest today is Grayson Owen, who has spent more than 12 years inside the insurance business and now works a corner of it most people never see. He is a disability income wholesaler, which means advisors across the Mid Atlantic, Southeast, and across the country bring him their hardest cases, the executives, business owners, and partners who need to protect their income that everyone else depends on. Before that, he built business succession and benefit plans for affluent business owners. So he has watched from every single angle what happens when someone's ability to earn a living is suddenly on the line. So, Grayson, welcome.
Jamie, thanks for having me. Really appreciate it.
Sure, excited to have you here. So, as a disability income wholesaler at DI Broker East, so kind of walk me through what an advisor typically calls you about when they have a client who needs income protection.
So great question. Yeah, and as you pointed out in the introduction, my primary role is as a wholesaler or acting as a middleman or liaison between brokers, advisors, and the disability insurance carriers. And most of the time, brokers are coming to me with cases, just helping individuals with their personal disability insurance needs. So paycheck protection or income protection, as we call it. They may or may not have coverage through work. Sometimes their earnings have outgrown any coverage through work if they are lucky enough to have that. And we're just making sure that they're aware and informed of what their options are for coverage so that way they can make a decision on their own terms. So that's basically what I do. And in the business market, it's similar. There's just other products and more moving parts, whether that's executive disability plans or the business products that exist out there. So I try to just help the brokers solve the problems and put options in front of their clients and take as a consultative approach as possible.
So I know you also work with a lot of like financial planners, RIAs, people like that, filling in for the disability insurance. Do you think that that industry is fully aware of income protection?
So that's a loaded question there. I'd say some are and some are not. What I will say is that since I was on the broker side from 2010 to the end of 2019, and so I kind of experienced the consumer facing aspect of talking about a variety of insurance products. And I can say that even back then, disability insurance was kind of on the back burner in a lot of those conversations. And so I know how it feels, whether you're at an RIA or a broker and you're juggling lots of solutions and planning aspects of the financial plan for clients, that disability insurance can end up, or it can be tough to keep on the planning agenda. So I completely understand that. What I've seen in more and more in like the RIA space and even in the employee benefits market is that they have so much going on. So in the RIAs, they're focused on assets under management, building financial plans. Some of them are fee only. They're not even insurance licensed. And in the employee benefits market, the compliance and the crafting healthcare plans for large companies, it is more complex than ever. So a lot of those types of professionals that may have dabbled in disability insurance 20 years ago are no longer keeping that on their radar. They don't have the bandwidth to keep up with it. So what I'm finding in that market is that we don't want those professionals to go have a one question conversation with their clients where it's like, hey, do you have coverage? And the client says, I think so through work. And they immediately check the box and move on to whatever else is on the agenda. We don't want them to do that. We want them to say, hey, do you have coverage through work? The client's going to probably say yes or no, or I don't know. And then after that, would you mind if we review that plan for you to make sure you're okay? Asking that one more question is the difference between helping the client and kind of just letting that go. And you don't want to let it go because if there's a claim later on, that client does not want to find out when they need dollars coming in the most that they didn't have the right type of coverage. So I'm out there in those markets trying to convince the advisors and the benefits producers out there that, hey, if you don't want to ask that extra question or ask any questions at all, you can actually put me into the conversation and I can run that entire discussion with your client just to make sure that they're okay. And so I'm doing quite a bit of that these days. So that probably makes up almost half my time is kind of offering that added service now.
Do you think that they just are unfamiliar with income protection, or do you think they just don't want to deal with it and that's just your area?
I think it's both now. So I know when you were on our podcast, you talked about the one card system. So when I started back in January 2010, I had the 3x5 index card,
Hmm.
card holder and a Rolodex. But within a year or two, it all became online CRMs. So I was on the very tail end of that whole thing. When I was being trained in those first 2 or 3 years, when I had those cards, it was by producers that were very successful that were trained in the 80s and 90s, and they knew every DI product, BOE, business disability buyout insurance, whatever it is. They knew all of those products inside and out, even though a lot of them were focusing on wealth management and life insurance at that time. Now, fast forward nowadays, and that training doesn't really exist.
Yep.
And so I believe that the product specialists and the DI focused wholesale brokerages like DI Broker East now have this opportunity to kind of be an extension of these teams to make sure that the clients are okay, because we cannot afford to have all of these consumers, working Americans in the US, walking around without knowing what their coverage options are. I think that that's a huge disservice and potential big problem for our insurance industry as a whole. So we have to find a way to inform more consumers out there. And if the consumer facing advisor on the life insurance or employee benefits market, or even advanced planning life insurance specialists, they just need to understand, hey, I don't have to go specialize in this. I can just go plug in a specialist that's already out there. And it doesn't have to be a wholesaler. It can be a specialized producer like yourself that they develop a strategic relationship with. And maybe there's revenue sharing. So that way it's mutually beneficial on the business side. And so there's a million different ways to design these relationships. But the important part is how do we inform more working Americans of these solutions so they can make an informed decision?
Yeah, that's really great. And I know you do a lot of work on LinkedIn just trying to spread the message, which I think is so important because I think for what I've seen, a lot of these financial planners, again, they just want to focus on their area and stay in their corner. They don't want to touch the disability insurance, but it's so foundational to all of the financial planning. So if they're not going to do, they're not going to advise with it, I think you're right. They need to at least refer or have somebody come in and fill that gap.
Yep. Absolutely. And our mutual friend, Mike Cogdell, literally wrote the book on it called Broker's Broker. And it outlines it. And it says in the book something that's very true, which is that this is probably the um, biggest opportunity in the financial services and insurance industry. So even agents who are coming up in the business right now, who might see, assets under management or advanced life insurance planning as the shiny object, I would highly encourage them to go understand the DI market and seeing if there's a way to create this broker platform for
Mhm.
themselves, because there is definitely endless opportunity from my perspective for up and coming brokers to go build this out long term.
Absolutely. So, across your 12 years in insurance, what surprised you when you moved from advising clients directly to wholesaling across many advisors' books? Like when you made that jump from working direct, although it sounds like you still do work with clients, but what kind of surprised you when you made that change?
So that's a great question. And I do work with clients, but only through brokers, right? So I don't do anything direct without a broker being involved. But yeah, so I when I was on the broker side, one thing that I found out about myself is that I'm a bit of a product nerd. And so I took that strength that I had, and I also determined that I'm really good at helping clients go over the goal line to make that decision, right? So and being consultative in the sales process. Finding new clients was probably not my strength, finding new clients from scratch. And at the tail end of my first decade in the business, I experienced two things. One was I had a client on a group employee benefits plan who experienced a long-term claim. And luckily, that claim paid out and provided the dollars that that person needed to sustain their lifestyle while they were on claim. That was eye-opening to me. And so seeing that happen, I was like, wow, I've written some disability policies, but I've never seen a claim payout.
Hmm.
And that was a very powerful thing for me because I was like, wow, like the rent or mortgage is getting paid now probably for this person because this plan was put in place and was designed with these XYZ definitions. And similarly, at the same time, I had a mentor in the business who got a very terrible diagnosis and was unable to work and actually had to leave the business. He was enrolled in a group plan, but never took the time, even though he was in the insurance business, to go get
Wow.
supplemental DI. And he was a mentor of mine, more on the employee benefits side of the business, but it's actually shocking how many of us in the insurance business don't have adequate DI or life or LTC, whatever it may be. And so for those listening, make sure that you're taken care of before you go out, preaching all these things consumers should have.
Absolutely. Yeah.
Um, and so when that happened to him, I saw what occurred in the claims process. He would tell me he actually, in that circumstance, I believe, eventually got approved for both Social Security disability and the group plan, but it was nowhere near what he was making pre-disability. And so that stuck in my mind. And when I left that firm, I had a choice, and I was either going to go rebuild my employee benefits business or I was going to go become that product specialist. And those two experiences really pushed me in the direction to go figure out how to be a wholesaler on the DI space. And I made phone calls throughout the industry saying, how do I get this started? Who do I talk to? And the stars really aligned because my friend who worked at Peterson at the time, Laurie Boggs, we were having a conversation, and she actually said, "Hey, you should call the Eskras because they're looking for somebody like you." And I reconnected with Michael Eskra, who I'd known from many years before. A firm I started with worked with him in Northern Virginia, and the stars kind of aligned, and I was able to afforded the opportunity to join DI Broker East and never looked back. So the unique thing about my producer experience is that I was with a few different firms, so I got to understand their vantage point and how they help clients. And so when I became a wholesaler, it helped me align with those types of producers to say, hey, I know what you're doing on a day-to-day basis. I'd like for you to think about these solutions for these types of clients that you're serving. So it allowed me to kind of attach to these different types of practices as their DI specialist in the background. And some of them want me, working with clients, but some of them just want me in the background. No wrong answer there. So my experience as a producer really helped shape who I've become as a wholesaler over the last 6 years or so. So
It's so interesting to me because it seems that, I mean, whenever you talk to somebody in the insurance business, everything is just so hypothetical. What if, what if? But when you actually see somebody go through it and a claim, and it sounds like you had two experiences around the same time, one where somebody was properly insured, one when somebody wasn't, but actually seeing it and seeing the reality of it really stays with you, and makes you realize what you're actually doing and the impact that you can have on people, whether they are properly insured or not. So I think that that's a really important point for people in the industry. And you never know when that's going to come about. But until you realize that you're actually helping people versus just everything's hypothetical, I think it makes a really big difference.
no doubt about it. Absolutely. Yep.
So, as a DI wholesaler who reviews cases for many advisors, paint me a picture of how a business owner's income can unravel when they can no longer work. Because I think there's some distinction between an employee, a person working for a company, and then somebody who has a business. So, kind of walk me through that for people.
Yep. Yeah, so obviously businesses are structured many different ways. And so you always want to figure out, are they a sole proprietor? Are they an S Corp owner or C Corp? All of those different things, or an attorney partner at a partnership law firm. All of those details matter. I would say most of the business owner cases that we review are S Corp owners. And a lot of times, what we're doing is if they have a group plan and they happen to be on the group plan, that's fine. Sometimes those are salary only. A lot of the S Corp owners might have very significant six-figure, even seven-figure K1 distributions. That's
Mhm.
basically their business profit, how I understand it. I'm not a tax advisor, but K1 is a type of income that the S Corp owner distributes usually at year end. And those earnings may or may not be covered under the group plan, depending on how they design it. And a lot of these S Corp owners, even if it is covered, have such significant earnings that they need to consider these individual products. So I would say that's the number one thing that I see come across my desk often is the S Corp owner that needs help shoring up at least another tranche of coverage for their K1 income.
Yeah, so for people who might be listening, don't totally understand it. Like typically in S Corp, somebody will pay themselves sort of just a base salary, like a lower amount, just to be able to cover, the for tax reasons, and the rest of it is distribution. So let's say they have 100,000 of base salary and 900,000 of just dividends that they pay themselves. Under a group policy, only that $100,000 income is covered, and the business owner might be reliant on the full million. So they need to basically, but on an individual policy, they can supplement and cover that full income, but the group policy won't pay that. So there's a big
Right.
gap for a lot of those people.
Yep.
Now,
Yeah.
what
The only.
about business overhead expense? Kind of walk me through a typical type of client that needs business overhead expense and explain how that works.
So the typical client that we see for business overhead expense is usually in the medical dental market. Usually dental is where I see it the most frequently. This product is used to quote unquote keep the lights on in the event that the owner goes down with a disability. And it's designed to help pay business deductible expenses for 12 to 24 months, depending on how the product's designed. It doesn't replace the owner's wages, but it would replace non-owner employee wages. And some of them can cover replacement costs too. So in a dental practice, that's very important, especially if there's only one or two partners, because if they have a client flow coming in and they have equipment leasing costs and utilities and overhead and whatever it may be, those expenses don't disappear just because an owner's out for 6 months recovering from something. And they may even need to bring in a non-owner dentist to help fill their shoes in the interim. And so, how do you manage all of that? And so, that coverage is designed in those types of circumstances. And we do see those in dental and medical practices the most often. But I
Mhm.
say that not because that's the only market. So, BOE should really be in almost every small business out there that is, obviously there's employee size that you want to consider a number of partners, but there's a lot of small businesses out there that have no idea that BOE, business overhead expense, exists. And I think that's a big problem. And so if you are listening to this and you're trying to figure out a way to go grow your DI business, I would always encourage you that leading with business overhead expense in the small business market is one of the ways to go about that. Because a lot of the owners have no idea and they understand this product because that's a true risk, not long term, but in a 1 to 2 year period. And the
Yeah.
last thing that I'll add about this is that the product is really designed to keep the lights on for that 12 to 24-month period. And I always say it's one of two reasons. Either that owner provides the owner some time to recover and hopefully return to work, or if they realize, hey, this is a permanent situation, or I'm not going to be able to recover from this in a timely manner, it buys them a little bit of time to go transition the business so that someone's running it for them, or potentially go to a competitor or another business and maybe say, hey, would you be interested in buying this out? And so it is kind of a band-aid coverage, if you will.
So yeah, so you mentioned, it seems obvious for a dental practice, and I've actually had claims with dentists who had to get a hand surgery and they're out and they bring in a substitute. But maybe kind of talk about what would be some like less obvious types of situations where BOE would come into play. What other kinds of businesses?
So this is kind of a different product category, but it functions as a rider on a lot of these products, which is business loan protection, so loan DI, and we may get into this later in the conversation as well, but
Mhm.
that's an overlooked area, and a lot of times that's part of a BOE product. And if you're in a dental practice and maybe it's a young dentist that went out and took a commercial loan to buy out a retiring owner, or they bought equipment or whatever it may be, and there's a commercial loan that they're personally liable for, the business is liable for. There's a rider on a lot of these business overhead expense products where it can insure, in the event of a total disability, the remaining amortization schedule on the loan. So those are things that, very dialed in DI producers, they know this and they're showing this to their small business owner clients on a regular basis. And so that is something that I would encourage anybody in the small business market to become familiar with so that you have that as an arrow in your quiver to help clients.
Yeah, so I mean, I get calls often where I have clients that are buying a practice. I have a plastic surgeon who's buying a practice right now, and his banker is contacting me saying, we need to assign as collateral some of his life insurance to the bank, but they never ask about disability. And so I'm like, but what if he becomes disabled? I mean, a plastic surgeon doesn't take much to disable him, and he's taking out $1 million loan. So in that circumstance, it could make a lot of sense to also get a business reducing term or whatever you call it, business loan policy. So again, it fills in the amortization. So if he gets
Yep.
disabled in year two, it would pay out year 2 to 10 back to the loan because those loans don't go away at the event of a disability. And he's certainly not going to want to have to pay that out of his personal disability,
Yep.
um, a sizable loan like that. So yeah, I think that that's really important.
Yeah, and
Now,
I've seen that as well. I just wanted to add, I've seen that as well where um a client will be told by a financial institution, the lender, that, hey, we're only requiring life insurance. But I do think it's always important to go that extra step and at least show them a quote, because if they're getting going through underwriting for something else, it's a pretty affordable product from what I've seen over the years.
yeah,
And
it's not that
so
expensive and it's a deductible expense anyway.
I think, yeah, the I think that the banks are missing out on understanding that, but
Mhm.
that's not for us to figure out today. I think that making
Yeah.
sure the clients are aware that it exists, and a lot of clients are going to say, "Oh, add that in there. We need to apply for that too."
Yeah, I mean, and it's a deductible expense. So for $1 million loan for the amortization, it might only be, 300, 400 a year. It's a very low expense, but it's got a big payout if something happens. So that's
Yep.
really important.
Agreed.
Okay, so now kind of moving into, do you do much in the multi-life space? Meaning you have business owners and they can issue guaranteed standard issue plans without medical exams. Do you work that much in that space?
I do, yes. More frequently in the non-medical market for
Yeah,
executives and
yeah. So
owners.
maybe
Yep.
kind of paint a picture, maybe for somebody who's listening, maybe who runs a large business, or kind of talk about the typical type of situation where it makes sense and what it actually does. So kind of walk me through
Yep.
that.
Yeah, absolutely. So there's really, I would almost say there's like three categories of companies that I see often that are looking for this. Sometimes it is like some type of medical or larger physician practice. And then sometimes it'll be like a professional service firm, like a law firm or CPA firm. But the most frequent, probably 80% of the RFPs that I manage and have helped implemented are usually these private companies, the S Corp owners. Some of them are family businesses. They have, some of them might only have 50 employees, others might have 400 employees, but they generally will have a core management or executive team of sometimes as low as five. Um,
Is
sometimes
five the
it
minimum?
depends on the carrier. I think there's a couple carriers that will go a little bit lower to three or four, but most of the carriers we work with, it's five, and
Okay.
that's probably the fair place to start, frankly, anyway. And usually when you're at 10 or more, that's where you start seeing more higher amounts of guaranteed standard issue or GSI offers that are going out the door. Um, in those markets, though, 5 being the minimum, we can underwrite, hundreds depending on who's in that eligible class. But usually the cases that I'm working on are anywhere from 5 to 30 or 40. That's probably the bread and butter in private companies usually. And this will include not only owners, but non-owner executives, and then also the management level as well. So sometimes
So basically you can carve out which people are eligible to purchase this policy, correct?
that is correct. And you usually have to have a group plan in there. Most of the carriers don't like it if there's not a group plan. The group plan is usually designed to cover, broadly and cost efficiently cover every employee there up to a certain amount. And so what we see is 2 different types of plan designs, right? Usually for the GSI or executive layer of coverage, that's either to make sure everybody's trued up at 60% across the board. So where the group plan is intended to be 60% up to 10,000 a month, anyone earning over 200,000 is underinsured potentially. So we want to add another layer of guaranteed standard issue individual coverage on top of that so that everybody is at 60%. That would be the goal. We call that a restoration plan where we're focusing on equalizing the benefit across all employees. The other type of plan design that we see is what I call an executive benefit, executive perk, a carve out, where you're actually carving out usually by title, sometimes title and income, but it's usually what we call a title carve out, where it might be, hey, your VPs and higher. So that could be, your C-suite, your president, your EVPs and your VPs. And maybe there's 15 of them. And anytime somebody gets hired into that class or is promoted into the class, they become eligible for the plan. And they might have a 60% to 15K group plan underneath that everyone at the company is on, mandatory on the plan. It might be employer paid. But for these top 15, the VPs and higher, they're going to get an extra, set amount of GSI guaranteed issue individual coverage to help supplement their coverage. And that's a way for the company to provide this extra benefit that's meaningful to their personal financial plan and risk management program, and then helps them get very affordable individual coverage, limited to no underwriting. In fact, most of this is census enrolled these days, depending on the occupations, which means that the executive really doesn't even have to sign anything. The employer sends in a census and they're mailed policies. And it's as
So the
literally
census
easy
is
as that.
just date of birth, gender, income, occupation, right? That's really all they need to know.
Pretty much address. I think there's social, there's like 4 or 5 other things, but
But the
yes,
demographic, yeah, so it's just really based on gender and age and what their role is, typically to price it.
that is correct. And even since, when I probably was involved in my first GSI case in 2013, when I was on the broker side, we had to create these like packets, policy pack or enrollment packets that you literally UPS or FedEx overnight to an executive. They had to fill it out, return the FedEx. You then the agent signs, then you have to FedEx it to the carrier. And it's a multi-week process, right? So we've come a long way from that carriers are now saying, hey, we're almost enrolling this like a group plan, if you will, even though it's individual coverage. So I think they have found ways to really dial in this process for
Now,
enrollment.
does it have to be standardized so they put together this plan, it's guaranteed standard issue. So meaning when somebody either gets promoted or comes into the company, they're eligible for this plan if they meet certain criteria, like whether it's title or income. So they can sign up. Does everybody have to have the same amount of benefit? Does everybody get 10,000 a month to age 65? Or can the people customize it?
So the product design itself, meaning the riders and those types of features, those are whatever the employer agrees to at implementation. So that's a
Okay.
great question. They cannot customize whether they want a cat rider or whatever the plan design is, it is what it is. Now,
Okay.
in terms of monthly benefit, that's always determined by the census data, the earnings, and that can fluctuate over time. And these don't have increase riders built on them like underwritten products do. But
Oh.
every year there's a renewal. So you have to send in a new census. So if earnings went up, they adjust the plan accordingly. Now, if you
Oh.
have somebody that goes up, up, and up, and then down, down, then they might be overinsured until it averages out over time. No way around that. But for the most part, it functions a little bit different that the only way they increase coverage up to the plan design maximum, the monthly maximum, is if their earnings support that.
Okay. And then who's paying the premiums, the employer or the employee?
So great question. So what I've just been talking about is really employer paid, which are mandatory plans. There
Hmm.
are some carriers out there that will entertain a portion being employer paid and then a voluntary employee paid buy up, or just a straight voluntary employee paid only. Those usually have to have a lot larger of an eligible class, and not all carriers are interested in that. So
Okay.
they're a little picky when it comes to that, unlike in the graduate medical education GME space, where that's basically a voluntary situation across the board in that market. So the employer market functions a little bit different. Although I'm sure we could sit here and probably make the argument on why is it just not voluntary everywhere. So
Yes. So the employer's paying for it, and then what happens when the employee leaves?
great question. So these products, the GSI individual products, are portable.
Hmm.
And even though I actually don't see enough executives taking advantage of the portability, it is a very key feature that should be considered by those executives. Now, sometimes an executive's leaving and their new benefits package offers something that's employer paid, and so they're choosing to just leave that behind or whatever. That's their personal decision. What I will add is that once a policy is ported out of the employer's plan, it can be maintained by the individual. They have to continue paying the premiums and do that directly with the carrier. They are not able to increase their coverage if they hadn't met that maximum
Hmm.
amount while they were employed. So usually that goes away with
Okay.
most carriers that I'm familiar with. So
So if they have a 10,000 a month benefit and they leave, it just stays at that amount
it stays, even if the employer's plan had a 15K max, if they didn't qualify for that, at the last renewal, um,
financially. Yeah.
they would be stuck at the 10. Yeah, they wouldn't be able to
Yeah.
increase that and then if they wanted more coverage, they have to go to the fully underwritten market. Yep.
Yeah, exactly. Okay. We're talking to Grayson Owen from DI Broker East. When we come back, the mistakes advisors make setting up disability coverage for executives before the case ever reaches Grayson's desk. All right, we're returning. Grayson Owens, Grayson Owen wholesales disability insurance across the Mid-Atlantic and Southeast, which means he sees hundreds of advisors' cases and the patterns running through all of them. We're back. Grayson, as a disability income specialist who has structured many executive plans, what's a moment you remember when advisors set up the coverage completely wrong before it reached you?
Ooh. So there's two examples I think I'd like to share. And the first one is I've had in the last, let's call it 2 years, I've seen two cases that really stick out as as kind of as cases that were set up incorrectly. Luckily, my brokers were not involved in how the process was implemented. They were brought in to review the coverage, and then we had to correct the coverage.
Okay.
Um, Within the last year before we received a request to review the coverage, another broker who really specialized in a different sector of the insurance business had written these two policies, and they were in the medical market, and they were missing residual and true own occupation on
Oh,
the
God.
policies,
Yeah. Okay.
which, as you know, Jamie, is basically basically the two most important features on a DI contract, especially in the medical market.
Absolutely. Absolutely.
So we had to go work with the carrier and figure out the best way. And one of the clients was able to it was actually 6 months previous. So the carrier was able to streamline the underwriting with a new application and implement a new product. And the other broker on that case actually had missed a discount available as well. So
Oh,
they couldn't just fix the current product. They had to go rewrite a new one in order to add the discount. So we were able to do that. The carrier was great in helping us get that all streamlined. So that was something that popped up. On the other one, we had to go to a second carrier for a variety of reasons, but both those clients are in better positions today after seeing that. So that's something you never want to see. And Jamie, I'd be curious to hear because I think I've only come across one of these before in the medical and dental market, but where the client had no idea they had the wrong features or definitions until it was time to, start looking at the policy because things weren't going well health wise.
oh God,
Have,
that's
have
terrible.
have you ever seen that happen? Because I've only seen that maybe once or twice where they didn't catch it in time. And obviously that's the worst case scenario. So have you seen something along those lines
It's
before?
pretty rare when somebody comes to me, especially in the medical market, if they don't have, own occupation or the
Right.
residual. But I've had people, they do come to me and I think it's not set up properly. Like you said, there's no discount on the policy. They never put on increase options on the policy. So they come to
Right.
me and they want to increase and they're uninsurable. And that's really
Mhm.
unfortunate. So that's not
Yep.
set up properly. Yeah, so it is concerning when sometimes people who don't know what they're doing and aren't setting it up properly and they're
Yep.
not working with a specialist. So yeah, it is really unfortunate. And sometimes people don't realize it until they file a claim and then it's definitely too late.
Yep. Then
So,
it's too late at that
and
point.
I also see a lot of times too, I mean, on a lot of the policies, you have to submit your financials every 3 years or
Mhm.
that rider's going to fall off the policy. And so
Right.
oftentimes I think the biggest mistake that brokers make in this industry is they're not keeping up with their clients. They're not systematizing it, reaching out and saying, hey, you need to submit this or this is going to fall off the policy. Whether you
Right.
want to increase or not, I think it's really important that you stay in contact with them because
Yep.
it might be 6, 9, 10 years later that they want to increase their policy and now they can't. And so they're stuck with a really small policy and now they're uninsurable. I think that's one of the
Yep.
biggest mistakes that I see.
Yep. No, yeah, that's probably the other one that would stick out, right? Is those come up very often, unfortunately. So, yep.
Yes.
Yep.
So do you do much in the disability buyout space?
We do, yeah. Yeah.
Okay.
So we
And
do
maybe
quite
kind of
a
explain what a buyout is and
yep.
how it works.
Yep. So disability buyout insurance, this is one of the products out there that very much underutilized in the market. It really irritates me actually whenever I see the LIMRA numbers every year and I think about how many businesses there are out there. And if you look at the number of disability buyout insurance products sold, it's like it's unbelievably low. I don't have the number offhand, but it's shocking. And if you were to compare that to the life insurance market on how many life insurance policies are sold in the business market for the purpose of funding a buy-sell agreement at death, it would be a drastic difference in products being sold. With that said, the purpose of disability buyout insurance is really there to provide liquidity or funding in the event an owner becomes or partner becomes totally disabled and it provides that liquidity so that the non-disabled remaining shareholders or business owners can use those dollars to purchase out the disabled owner's shares. And that's very important because when that happens to an owner, especially if they're active in the business, you don't want a totally disabled owner remaining in the business, drawing a salary. It becomes a big problem potentially. And so having the business owners that, for any producers listening to this, when you work with clients in the business market, they need to be working with their tax advisors and legal counsel to make sure they have these agreements and documents in place, and then working with somebody like Jamie and making sure that they have the right products there to provide liquidity. Now, I will say that my approach to disability buyout insurance, I don't know if it's unique or not, but I kind of go in there sometimes as a devil's advocate and I kind of start the conversation by saying, hey, if you woke up today, Mr. or Mrs. Business Owner, and you're totally disabled, what's the plan for the business right now? I want to hear how it plays out because maybe insurance doesn't need to be involved. Or maybe you just need to insure a portion of it for the next 5 to 10 years while you have the means or another plan for funding comes into view. And so it's not an all or nothing play. And I think that's what advisors miss out on, is that if they have the $10 million business and they have two owners, they present $5 million a piece of disability buyout insurance. And if the client says, hey, we don't really want to insure this, the conversation should really be, hey, this is what it looks like with no insurance. This is what it looks like with some insurance. And this is what it looks like for insuring the whole thing. And taking that approach actually changes the conversation a lot of times. So I would encourage anybody listening to consider taking that kind of layered approach to presenting. And the last thing that I'll point out is that in the business owner market, a lot of other planning's going on. And so they might have decision fatigue. So if they're dealing with life insurance, they have to deal with their group plans, whatever else they have going on. And so finding a way to grab that owner's attention is important. And so I would encourage everybody, if you're working with them on the life insurance side, talk to them about the disability at the same time. And I know that that's really tough to do because you're like, I just want them to focus on one thing at a time. Actually, in their perspective, it's risk for the buyout. There's buyout risk. And so there's multiple risks within their buyout agreement. So I believe presenting those solutions in tandem is the right thing to do. Now, the last thing I'll share is the disability buyout products age out. So this is not like life insurance that can be permanently held. So if you have a lingering family business owner that works until their 80s, which everybody has probably met clients that want to work that long, and that's fine. Permanent life insurance can still fund a buyout later as long as it's maintained, right? Disability buyout insurance, usually a lot different. It's harder to maintain. Even if you go to the Lloyd's market, it becomes very expensive, into the 70s and everything. So that can be considered. Obviously, there are markets to vet that solution as well. But at the same time, I would just argue that, if you have the aging business owner, you want to have a conversation with them about, hey, how long should insurance be part of the equation? And should there be another strategy that you should be considering with your legal counsel and tax advisors that doesn't involve insurance if a disability occurs? So I might have thrown out too much information there, but
No, so I mean, I think maybe kind of going back, so maybe just say there's, like you said, there's two business partners and they run a big business, a very lucrative business. What happens in the event that somebody becomes disabled when there's no insurance? Like what's required? You have two business owners, they're
Yep.
partners.
Yeah. So if let's say they have a buy-sell agreement that says, hey, whatever the value is at the time of disability, they have kind of two challenges. One is if the buy-sell agreement says, hey, within a year, you have to pay the full amount of that person's shares, that could be a big problem coming up with those dollars. Even if it's structured as a 5-year payment or whatever, who's paying that? The business? Is that the other owner's profits that are going to have to pay it? I don't have the answer to that, but you can see very quickly how that could become a problem.
So if the business is worth, say, $1 million and you have two partners and one becomes disabled, without any plan in place, the disabled partner would still be pulling in $500,000, correct?
Yeah. Well, let's just say, if they had a K1 of, a few $100,000 or whatever.
Yeah. So they would still be pulling it out even if they're disabled. With a buyout, you'd say, okay, you're no longer able to work here. Here's your lump sum for 500 by partner two now runs the full practice. Is that the way that works?
Yeah. If there's insurance involved, it helps kind of, it guides that process a little bit.
That person just sucking the resources out while they're not working. Yeah.
Yeah. You want the product to flow with whatever's in the agreement. So in that example, if there's insurance that pays a 500 lump sum after a year and the lump sums due according to the buyout agreement, then that works perfect in those circumstances. When you don't have insurance and the 500,000's due, then you have to come up with the money. And you also, as the company, need to have guidelines on who determines who's disabled, because you don't have an insurance carrier to determine if you're totally disabled or not. So you have a whole nother gray area. in the plan when there's not an insurer involved. So there's a lot to consider. And those are very important things for business owners to be working through with their legal counsel.
Exactly. Exactly. Okay, we got to do another. We're back with Grayson Owen from DI Broker East. When we come back, what happens when a carrier's underwriter pushes back on a disability case and the advisor never saw it coming? Grayson Owen has spent more than a decade inside disability income, from business succession planning to wholesaling executive coverage. Let's pick up back where with Grayson. Okay, so Grayson, with your chartered life underwriter training, CLU, what's a moment when a carrier's underwriter pushed back on a disability case in a way that you didn't expect?
Well, usually that happens when there wasn't adequate field underwriting or pre-screening completed by the agent. So
Okay.
while I would love to say that all the brokers and advisors that I work with are the best field underwriters, that's simply not the case. There's cases that slip through the cracks, or there's advisors that just do not have that as part of their process for whatever reason. So I think to answer that question, I could probably sit here all day with examples, but if you're okay with it, I'd like to touch on the importance of pre-screening and
Of
why
course, yeah.
that could help alleviate these potential issues. So when we're talking about field underwriting, as it probably used to be called, we call it pre-screening now, I guess. That's really doing an informal kind of questionnaire or interview with the prospective client ahead of a formal application to not only understand their medical profile, but also their financial, to make sure they're a good fit for the carrier that they're applying to. But more importantly, it's to set expectations of the most likely outcome. And while no outcome is guaranteed, we want to at least make sure the client's applying to a place that they will likely have the most success and that they're prepared. So to use myself as an example, I had elbow surgery back in 2009. I have no issues. So no carriers probably riding or excluding my elbow. But using myself as an example, if I was still getting PT for my elbow, every carrier, if I entered into underwriting today, would say, hey, you have an elbow exclusion, at least until XYZ years. And so that's just how it is. And so the client needs to understand that a known higher risk of disability to a carrier presents a gray area. They can't insure the gray area. A lot of times, if they can isolate where that risk is, they're going to exclude and move forward with an offer. I also have obstructive sleep apnea, and even though I'm fairly healthy, I've had sleep apnea since I was running half marathons, and I was
That
five
seems to be
six.
really common lately. My gosh, I'm
Yeah.
seeing a lot of that. Yeah.
In 2014, I was diagnosed, and at that point, I was running half marathons. I was 5'6", 150 pounds. I was surfing, and I developed it, and it is what it is. And I sleep with a CPAP, and because it's well controlled, I can actually most likely go get coverage with something like that today. But some carriers will outright decline me, and others
Mhm.
will rate me right out of the gate just for having that. And so that's what we call a rating. And so clients need to be aware of what could be excluded, what could be rated, and what that means for their premium and holes in coverage or gaps in coverage potentially. You want to make sure that they are okay with that before moving forward. Because if you do find that out on the goal line when you get the offer and it's a surprise, it's very hard a lot of times to convince the client to move forward with coverage. They start feeling uncertain about the coverage, or they want to go look at other options, which they're entitled to do for sure. But all I'm saying is that in a process to prevent those surprises, you want to set expectations up front. And
Yeah.
the last thing that I'll share about the importance of underwriting pre-screening is that, as our friend Mike Cogdell always says, you're only one doctor's visit away from being uninsurable. I actually had an ER visit unexpectedly about 2 weeks ago.
Oh,
And luckily, what we were worried about me having was not an issue, but I did leave with a new diagnosis. And it's nothing too crazy. It's some neuropathy in my arm, but it's enough to cause a gray area that I would probably be postponed right now if I went into underwriting, to be
yeah.
very frank. I would be postponed because they want more information. And the reason why I'm bringing this up is not to just divulge my health history everywhere. It's because I believe that it's important that your clients need to go get coverage proactively while they're young and healthy. That's the goal. And you can balk at fear-based selling or insurability sales as much as you want. But at the end of the day, anybody who has adequate coverage when a health event happens later in their working career will be thankful that they had that coverage. And they will never view that as fear-based selling. And I do hear that sometimes in the marketplace. So I wanted to address that today,
Mhm.
is that insurability matters and it should be more heavily considered in the planning arena.
Absolutely. So something that I've been noticing a lot lately, just even in the last month or two, I don't know if people are hearing this on ChatGPT or whatever, is I have a lot of people coming to me saying, I want to apply, but not formally. I just want to pre-screen. I want you to run it by an underwriter anonymously. I don't want it to go through the MIB. Maybe walk me through how that works, if that's even possible, and what that looks like.
Great question. So, that is an important process for some clients. I'm not sure every client needs to go through
Yeah.
that. And you would probably agree that you don't want to like bog down the carriers with, if you know it's a mental nervous exclusion only, we probably don't need to go there. Um, so that is important for some clients. The process for that, we have a team at DI Broker East, our quote team, arguably the best in the business, and they know the carriers inside and out. But we do anonymously pre-screen cases sometimes, especially if there's a lot of moving parts or if there's a
Mhm.
gray area like sleep apnea or a recent neuropathy
Those are, yeah,
diagnosis.
those, and it seems like most of these people do have sleep apnea that are contacting me who want to
Yeah.
pre-screen.
Yeah,
So,
because some carriers are going to be a decline. Some will be
yes.
25% rating, and others might say, hey, we're good with standard as long as there's nothing else going on. And
Hmm.
so I think in those instances, you have to pre-screen. It's the right thing to do.
Hmm.
If you know that the client just had perfect labs and has nothing going on, they say that they're good to go, and their script history only shows an ADHD medication, then you likely know that that's going to be a mental disorder exclusion, and they would probably be okay to apply to see what happens. But that's up to, I believe, the producer and client to kind of sort through. But the more gray areas, the more likely there needs to be a pre-screen. And
Hmm.
I always go back to think, not every client divulges all the right information. So you do always want to use soft language and just say, hey, if anything else comes up, if you decide to move forward formally without a pre-screen, that's okay. But just know this is how exclusions work. This is how ratings work. And they could postpone or decline depending on what's in your records. And usually when you go through that process, it allows the client to feel comfortable about saying, actually, I do remember having this a few years ago. What would that mean for the coverage? When you have a client that's willing to have those conversations with you, even though they can be tough and challenging sometimes, you know that they're willing to put in the same amount of effort as you are to go solve this puzzle for them.
Yeah. And something that we've been doing lately too is writing a letter of clarification or a cover letter with the application. So, for example, I had a client who applied with one company and they just said, nope, we're not doing that because you have XYZ. It was like an autoimmune. And she came back to me. She's like, I don't have an autoimmune. Back when I was in med school, I was exhausted. I went to the emergency room. They said they gave me some medication. I've since been better. Everything's okay. But the company just saw it, they didn't really dive deep. They didn't want to see it. And so we wrote a letter of clarification. We applied with another company and we got a regular standard policy. And so I find that really fascinating because I think there's some companies that aren't really willing to take a deeper look or really look at everything, even though we had pushed back with them. It was just a knee-jerk response.
Yep.
Whereas other companies, sometimes if you line it up and you explain the situation, this has never happened again, it was a one-time incident, whatever it is, some companies will be willing to listen because not all the
Yeah.
companies are the same when it comes to underwriting.
That's right. They change their tune fairly often. What I would say, as I've gotten to know underwriters over the years, I understand that they only have one chance to underwrite a case. But you're exactly right that every carrier views certain risks differently, and that changes over. It's kind of ever evolving. And so it is good to understand, who's the carrier we should focus on, and also knowing when to pivot. And I like that idea there of the cover letter. What
Hmm.
I always try to tell advisors, I used to do a lot of painting back in the day. And so it's like when an underwriter gets a file, they have a blank canvas. The application helps fill in that canvas or whatever, but the more details you can provide that are concise and being asked about to that underwriter, it affords them the opportunity to have a better picture on that canvas of what's going on. And in a lot of those complex situations, sometimes it's pivoting carriers just to paint the same picture, and it
Hmm.
allows another underwriter to say, hey, we're okay with that risk actually, because as long as it falls into XYZ guidelines. So
Hmm.
I do like the idea of pivoting with the cover letter, and that has to be done sometimes. So
And do you think that sometimes these companies are just using AI saying, oh, we checked that box, oh, autoimmune done, as opposed to really taking an extra time to look at it more carefully? Do you think that that's starting to happen?
I
I'm,
don't
I'm
know all.
noticing that with some of the life insurance carriers. They're just like, they just have boxes. I swear it's just AI slop. And they're not really looking at the whole picture, like you said.
I think the conversations I've had with DI underwriters, it seems there is still a very involved human element. I do
Good.
know they have all these third-party databases that seem to know more about the clients than the clients themselves, which is frightening in and of itself sometimes.
Yes.
So that's clearly going on. But I think that the underwriters that I've had discussions with on recent cases, they use that as a way to kind of, you know, paint the canvas again, right? So it's a way to kind of fill in the gaps, see what matches on the Part B medical questions and the finance, all of that stuff. But I don't know if any DI carriers are using AI to, check certain boxes and look through all that stuff. I don't know how that would work unless they're using it for, APS review, but I feel like keeping a human element in there is very important, because in my studies of AI from an operations standpoint is that the AI is only as well trained as whoever did the work to train the AI. So if
Yeah.
if there's any type of bias with the AI, then that's where the human element needs to step in and make sure nothing was missed. So I think
Yeah.
that I don't know where AI is being played or being used on the back end, but I'm sure it's being used somewhere. Yeah.
And I think there's still a human element. I think that's the importance of a client using somebody who or working with a broker or somebody who has a lot of experience, who actually listens and looks at the whole picture, who can
Yep.
guide them in the right place, because what might be right for them might be totally different than their coworker who got something else. So
Yep.
there's a lot of moving parts.
No doubt about that. No doubt about that.
Okay, couple last questions with just sort of quick answers.
Yep.
If you could put one line on a billboard for every business owner who thinks their savings will carry them through a disability, what would it say?
So the question's one line for a
Like, what would be
billboard.
a one line billboard for business owners for income protection? You know, the ones that think that they're covered.
Oh, that's a good question.
You're good at
I
these things. You're always posting these things.
Yeah, I think that my favorite that I've had a t-shirt made with this is where does the money come from? Question mark. Um, and you could actually put a blank before the question mark, which is to fund your buyout if you're totally disabled, to prepare your business for the loss of a key employee due to a total disability, or if your income stopped, where does the money come from if your income stopped? Question mark. So I think where does the money come from, and then maybe some fun creative explaining that it's disability related. That's probably where I would go for. I actually have an advertising background, so
Hmm.
I like to kind of think through those things, but where does the money come from would be my answer.
I think
So
that's great. I think in so many situations, like you said, like the buyout. Okay, one goes down. Where does the money come from? Or,
mhm.
you know, you're supporting a family and something happens. Where's the money going to come from? I like that. That's really
Yep.
great.
Yep.
Okay, so finish the sentence. The way most executives buy disability coverage would be unrecognizable in 10 years if advisors just. fill in the blank.
Proactively and consistently discussed income protection.
Very good. What's your take? Wait, hold on. Grayson, what's a take you have about executive disability plans that most advisors in the industry would push back on?
I believe, I don't know if they would push back on this though, but I'm going to say it anyway. Um, I think that it might be startling to some, but it's important. And I talk about this on LinkedIn a lot. I believe that executive disability plans are one of the most overlooked solutions in the benefits marketplace. And that because benefit brokers are inundated with a million other things, they leave this behind. And so the question is, if your clients are not informed about these things and they're not able to make a decision about it, by you not talking to your HR and CFOs at your employer clients, if you're a benefits broker, you're making a decision for them. But do
Hmm.
your clients know that you're making that decision for them?
Ooh, I like that. Yeah. So what's the dumbest assumption you see business owners make about how their income would hold up if they couldn't work?
Um, it pains me when if I'm on a call with a business owner who might be adverse to insurance in general, and they try to figure out a way to almost like convince me that if a total disability would occur, their business would just keep paying them no matter what. And maybe that's true in some instances. So I don't ever discount those conversations. But depending on the structure of their business, their buy sell agreements, there's a lot of things. If an active owner, if it's a small S Corp company and that active owner's not there, do the client relationships stay? There's a lot of variables. So I would say the business owner marketplace, there are owners who they don't want to insure anything they don't have to because it's a cost. But I think they have to kind of take the business out of it sometimes, especially for personal income protection planning, and say, hey, to protect you and the family and your family unit, business aside, that's your income, that's your golden goose that's generating your income. But if something happens, is the business still responsible for paying your bills? So you kind of
Hmm.
have to have those conversations, sometimes several times, to kind of figure that all out.
Absolutely. If you had to bet on one number, the share of executives who believe that they're covered but are not, where would you put that number?
Believe that they're covered or
Yeah,
not.
they think that they're covered, but they actually aren't adequately covered.
I think that the employer market, I think it's less than 35% offer LTD plans in any capacity. So to answer that, it's probably at maybe most of those people, because some of them might be adequately covered, but the vast majority of that low percentage of employed executives out there, they might think that 60% to 5,000 plan, their employer's taking care of them. They've worked there for 30 years. They would never be offered a benefit that wasn't up to par. And so a lot of people just kind of, they never think about that. And maybe they see the 60% and they don't see the 5,000 cap. So
And
there's
they
a
don't see
lot
it's
of,
taxable. Yeah.
yeah, they don't know the taxability. Yeah, we could talk all day about that, but I would imagine it's a very significant portion of the of working Americans that are executives out there. The scarier part though is this, that there's under 40%, I think, of employers that offer LTD in any capacity. I think it's like low 30s when I was told this before, but
Wow.
I don't know the exact percentage, but it's like pretty low apparently.
Which means two-thirds of people don't even have coverage to their work. And
I
those that
believe
do
it's
may not
something.
even be adequately covered.
Right. They don't know, and they don't know. Yeah. And you don't
Yeah.
want to find out at claim time that it wasn't the right coverage. So
Yeah. What's the most uncomfortable truth about how disability insurance gets sold through the advisor channel?
the most uncomfortable truth. I'd say the most uncomfortable truth is if you're in the advisor channel and you are not talking to every single client that depends on their income about disability insurance, The question is, I know the term fiduciary is thrown around a lot, but if you're considered, a financial fiduciary advisor and you're not bringing up income protection, yet an entire client's financial plan is, dependent on their ability to earn an income, are you really acting in a fiduciary capacity? I don't know the answer to that, but it's a good question to ask that marketplace because a lot of advisors ignore that. They want to stay focused on assets under management or, estate planning, retirement planning objectives. And those are all very important things. But what if you have a high earner who's just starting to save and they're a house of cards right now to meet those goals and objectives in the midterm and long term? And so you have to ask yourself as an advisor, like, hey, what are these risks that are out there that need to be shored up? And it's not about selling insurance that doesn't need to be sold. It's about making sure your client can make an informed decision whether or not they need to have insurance for a set number of years. And so that conversation needs to be had. I think the uncomfortable truth is that not enough advisors are having that conversation.
Very, very well said. Completely agree. Okay, last question. If every business owner grasped one thing about income protection before they got sick or hurt, what would it be?
Repeat the question on that.
If
The
every
advice
business owner, they
business owner.
grasped one thing about income protection before they got sick or hurt, meaning what is the one thing that they need to understand? What would it be?
I think the most important thing is they need to go have, a conversation with whoever their trusted advisors are to understand what happens with and without insurance. And then they need to make a judgment call, would you be okay without insurance? Because most would not be. And so again, it's not an all or nothing, but what is the right number that they can feel confident in, but at the same time, not feel like they're overdoing or overspending. So I really think they need to go have that conversation with whoever they trust, whether that's an insurance professional, financial advisor, CPA, attorney, and they need to have a real kind of kitchen table conversation that, hey, if there's no insurance here and something happens, how does this unfold? And does it make sense for me to carry some insurance at least for a set number of years? And I think when you have that type of consultative conversation with a business owner client, they can kind of overcome a lot of the mental blocks and hurdles that they try to create to stop with moving forward. So.
Absolutely. Very well said. Well, my thanks to Grayson Owen, who spends his days looking at disability insurance from a vantage almost no buyer ever gets, the wholesale side, where hundreds of advisors' cases reveal the same blind spots again and again. So what stays with me is how often the gap is not the policy itself, but the assumptions people carry into it. So Grayson's reminder is that income is the engine behind everything a business owner builds and is the piece most of them forget to protect. So thank you, Grayson. I really appreciate you being here and your insight and your stories was very, very insightful. I really appreciate it.
Thank you, Jamie. Appreciate you having me on. It's been an honor. Thank you very
All
much.
right. Thank you.